Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you a little bit different type of subscriber request video. I was doing 2-minute drills, and I actually have to thank y'all. I've gotten so many requests from subscribers to cover certain companies that I'm simply not able to do them all, especially in an independent or individual video on each company. So what I'm going to do here, I'm going to experiment with this, and I appreciate your feedback. Let me know in the comment sections what you think. I'm going to look at 5 companies at a time here, in alphabetical order, by the way, that subscribers have asked me to cover. I'm going to do this very high level, but because I'm showing the video of a certain company or showing the fast graph of a certain company, doesn't mean I'm recommending it. It simply means these are companies that you guys wanted me to show you. Some of them are overvalued, some of them are fairly valued, some I wouldn't invest in with anybody's money, some I think are very attractive, but you need to decide that for yourself. So I'm going to do this on a high level, try to keep it still as short as I possibly can, covering 5 companies. But again, these are companies you guys have asked to see. So let's go ahead and get into the fast graphs and look and start with the first one. I'm going to cover 5 in this video. The first company we're going to look at is AES Corporation. Now, I'm going to go to the historical fast graph here. This is an independent power producer and trader. Okay, you can also almost look at it as a quasi-utility. So in the fast graph, the first thing I look at is operating earnings. That's the orange line on the graph. And you can see that this company has what I would call quasi-cyclical earnings. The earnings, they have some strong earnings growth followed by a down year coming into 2007, then a down year during the 2008 recession. Then they had some really positive years. On average, the company's grown earnings over this time frame at 5%. They started paying a dividend, if you will, in December of 2012. And they've paid a dividend, and they've raised that dividend pretty consistently every year since, although they're expected to freeze the dividend for the next couple of years. Whether that's true or not is for you to determine. So the gold line is the dividend, the orange line is the earnings growth, and the blue line is the average value that the market has applied to the stock over whatever time frame I'm raising. Fast graphs are dynamic. As you change time frames, things like the rate of change of earnings growth, the normal PE ratio, that kind of data is going to change because you're looking at different time frames. Here you're looking at a whole 20-year period. I drop it to a 15-year period. Now I've got 4% growth, but that's because I've got like 4 years in a row here of virtually negative earnings, if you will, or very flat earnings. Okay, so I drop that to 10 years. Now all of a sudden I'm at 7.9% growth. That's why I call fast graphs a tool to think with. Now I'm also going to tell you these nearer years, in my opinion, are more important than looking at the long years. The long years, the long periods of time give you some insights into how well the company has operated as a business. But if you're investing in the company, you really want to know what it's done lately, and ultimately it comes down to forecasting. Okay, we're going to look at the future before you invest. So this company's grown at 5 or 6% a year. It's paying a dividend right now of 6.24%, and it has a blended PE of 5 and an earnings yield of 19%. Well, that statistically tells me the stock is very undervalued. When I put weekly closing stock prices on the graph, I see there was a period of time where the market was overvaluing it. Then coming in during the Great Recession, as I call it, they really put it cheap. And then we had this period where the stock kind of just faltered around a 10 multiple for many years. And then it got cheap again, and then it got expensive again, and then now it's cheap again. And we're coming up to a really good earnings year that we just finished in 24, but then we're expecting very flat earnings in 2025 and not a lot of growth following that. And this is operating earnings, so the stock has fallen a great deal. Now what this means is, from a forecasting point of view, if this company traded only grows at 2.89%, and that calculates using the Graham-Dodd formula to a 14.28 fair value PE ratio, if this stock moves back into alignment with that, you could make huge rates of return over the next 2 or 3 years, annualizing at over 50% a year. The market has tended to discount this company, so even at a 14.47, which would be their 5-year normal PE, it's still a huge number. But again, that's a what if scenario. What if the company earns this amount of money, and what if the market brings it back to its more normal valuations as it historically has? Okay, great yield, cheap stock, fundamentally strong, a little bit debt laden. I think that's important, but it does have an investment grade balance sheet, triple B minus rated. Now, very quickly, I'm going to go through the other metrics on FastGraph on AES. You've got basic earnings, and you'll see a lot of accounting convention where the earnings disappear quite a bit, and the stock includes just about everything. And diluted earnings are going to give you a picture very similar to what you saw with basic earnings. This would be GAAP earnings. But I do want you to notice with GAAP earnings, the market doesn't really react to the earnings as clearly and consistently as it does to operating earnings. Operating earnings, prices tend to track operating earnings. But since this is a dividend-paying stock, operating cash flows really cover the dividend like a blanket. I think that's important. The operating cash flows are significantly above what the dividend is. If I look at free cash flows, again, as a subscriber, it doesn't look real promising as far as the dividend is concerned going forward. And again, the company has a relatively short history. Sales are relatively flat to negative, so that's what AES looks like. The thing I'll say about this stock is it's cheap. The next stock on the list is Amgen, the world's largest biotech company. So let's look at Amgen from a similar way. Very consistent earning growth. Once again, started paying a dividend in 2011, but that dividend has grown very fast each year since. If I look at the other types, I'm just going to go to diluted earnings here. We still have pretty good earnings, but there is some accounting conventions, some depreciations or write-offs or whatever that you'll see. But once again, you'll notice that that doesn't have a material effect on the price as much as pure operating earnings do. Look how closely this company's price follows its operating earnings. Now, there's always going to be the inherent volatility of ups and downs, but it's always moving back to the orange line. When the price gets above it, it moves back. When it gets below it, it moves back, and etc. Now, I can look at this company, since it is paying a dividend of over 3%, I can look at this company from a standpoint of operating cash flows. The operating cash flows clearly cover the dividend. Look at it from a free cash flow to equity. Free cash flow to equity clearly covers a dividend. That tells me I think the dividend here is very, very safe. Now, I can go deeper on every one of these companies by going into fiscal fitness, and I can look at things like return on invested capital. That has been going down for the last several years. That would be a red flag. I can look at return on equity very similarly. And here we've got a little better picture, although it did go down in 2024. We can look at return on assets. And here the return on assets has been dropping. We can look at things like net margins. And my point is, I'm not going to do this. These are a high-level presentation. Their margins are weakening. And if I look at the margin for the last 5 years or so, which is to me the most important to look at, the net margin has been dropping on Amgen. And that partially explains, at least to me, why the stock might be actually inexpensive right now on an operating earnings basis. Okay, it's actually undervalued, but moving back into fair value. From a forecasting standpoint, we're not expecting a lot of growth going forward, but with the dividend and the ability to see the PE rise from a 14.46 to a 15, which is just very little PE expansion, we can still generate a pretty decent rate of return on Amgen. The next company is Air Products. Now, Air Products had tracked earnings very nicely up and through about 2013, like a lot of stocks. Valuations got high. It had a normal PE of over 20 during this period of time and a growth rate of about 7.5%. But once again, I always want to basically evaluate what happens to growth as I change time frames because I'm measuring different periods. I go to 12-year, growth is 6.5%. I go to 8-year, it's 6.9%. So it's really relatively consistent. But the thing is, the stock is overvalued, and as a result of being overvalued, there's been very little performance in this company from an investor's point of view, even though the stock has done fairly well, and they have been raising their dividend every year. It's an A-rated company. It has modest debt, 47% debt, which is, I think, excellent for the company. So I like this business a lot. I just don't like the price that the market is currently offering it at. If I look at forecasting and the stock does revert to the mean and go to a 15 PE ratio, you would be losing about 9% a year. You stand to lose a relatively strong portion of your money over the next 2.5, 3 years. Not because the business is so bad, because the valuation is so bad. The next stock we're going to look at is ASML Holdings. This is another company that's very interesting when you change time frames. It's a semiconductor materials and equipment. It was very cyclical back here. It did pay one special dividend in 2012. You can see that they must have paid about a $10 dividend, I'm guessing, or even a $12 dividend. You can look that up. But as I shorten the time frame, we've had 18% growth over this time frame. As I shorten the time frame to the last 12 years, it's actually accelerated. Growth has gone up to 21%. If I do it for like the last 8 years, it's 23%. If I look at forecasting, analysts are expecting 19%, and it has a relatively decent analyst scorecard, but I do think the stock is way overvalued relative to that growth. If it traded at a 19 equal to its growth rate, you would actually lose money buying the stock today. It's a very good company. My argument is buy it when it's cheaper. Now, again, as you shorten this time frame, valuations don't look as bad, but it's rarely in a position where it can be bought at a very attractive valuation. And the last stock I'm going to look at is AVGO. And I like looking at AVGO or Broadcom. AVGO is the symbol. Broadcom is the company. Now, I want you to notice by looking at this long-term chart, let's go to the historical chart, the stock has almost never followed the orange line, which is a P equals equal to growth. That would be a 31 PE. It has really been a 15 multiple company, which is the blue line, 15.45. Don't get too hung up in the decimal points. Approximately a 15 times earnings company. So if I take the fair value ratio off the graph and just look at it from the standpoint of the blue line, it clearly becomes a picture that looks overvalued. Now, the growth rate has been 31% for this long period of time. I drop that down to 12-year, it's down to 21%. I drop that down to 6 years, it's back up to 22%. I look at forecasting for the company, and it's expected to grow at 22%. I think that it has an impeccable scorecard. Analysts have gotten it right most of the time. The problem is it has great growth. It's now involved in AI, and that's stepped up the value of a lot of companies, but I don't like the valuation. I think the valuation is too high. I'd pay 20 to 25 times earnings to buy this company. I don't want to pay 41 times earnings. Let's talk about earnings yield just a little bit. This is a 2.5% earnings yield. That simply means if you owned 100% of the company and they paid you all their profit, you would only earn 2.4% on your money. I don't consider that attractive enough for a company that basically carries the risk, especially the valuation risk that this particular company carries. It's a blue line company, in my opinion. The valuation, less overvalued, more benign, but I think the stock is clearly overvalued. I don't think it's going to trade at 31 times earnings. In fact, if I go into the forecasting graphs and if I look at the normal multiple here and run the table of the normal multiple for this stock, you'll see that it's been around 15, 16, on the high side 17, and then we got into the 20s in the last couple of years. But that's excessive valuation. That's a very high risk situation. I love the company. I'm actually long the company. I've sold out twice since I've had the company. I've taken my money off the table. So I'm playing with house money, as the saying goes. I still love the business as much as the day I bought it, and I bought it somewhere in here. What I don't like is the way the market is valuing it now. Anyway, this has been Chuck Carnevale, bringing you another way to try to cover some of these subscriber requests. I do appreciate you guys giving me the requests. The problem is there's just too many for me to get to. So I'm going to try this 5 at a time, just a real high-level look, try to kind of give you my quick opinion and give you the ability to determine whether you want to look further into the company or not based on what I can basically illustrate to you about each company as I go through. I'm going to do 5 at a time, so I got more videos like this coming. If you enjoyed the video, give me a like, ring the bell so that you get access to next videos I produce on this kind of subject. If you don't subscribe to the YouTube channel, please do, because that really helps us a lot and also I think helps you. and take a look at subscribing to Fast Graphs. It can keep you so grounded as an investor, and it really simplifies the investing process, and it gives you facts. It doesn't give you opinions, it gives you facts. And to me, facts are the most important thing to deal with as an investor. Thanks for watching. Talk to you again real soon.